and welcome back everyone. We are going to pick up where we left off as we continue our series on financial management strategies for African startups. In today's session, we are going to delve into financial modeling as a key tool in developing investor-ready financial projections. These are essential to your startup financial management strategy. We'll start with a quick recap from our previous discussion and then jump into a practical demonstration of how you can develop a comprehensive financial model similar to the one that you see here. In our previous session, we discussed business life cycles and funding requirements at each phase. We also talked about documents required when requesting funding. Financial projections is a key document when you are requesting funding. Remember, investors seek the story behind the numbers, and today we will demonstrate how you can translate that story into financial models that inspire investors to invest in your business. In our last session, we discussed how financing needs to vary across different phases of a business's life cycle. At launch stage or startup stage, which is the stage that you are in, we highlighted the need for seed funding or bootstrapping, focusing on covering the initial development and operational costs. At growth stage, we discussed the importance of venture capital or debt financing to scale operations and expand market reach. At maturity stage, we explored how businesses often seek strategic investments or consider going public to fund further expansion or acquisition. Profitability and market share become very critical at this stage. We also touched upon strategies for managing cash flow and potentially restructuring or pivoting the business or even diversifying your operations. At this stage, we said cash is king. See, these stages are very important when you are creating your financial model because they drastically change the assumptions that you make. For example, at growth stage, a company needs to show rapid scaling, while a mature company needs to show profitability and stable cash flows. We will have a closer look at this when we explore our financial model. But before we get to that, let's connect these funding considerations to the essential investor documents that you will need to submit to your investor. These documents are the building blocks to your financial model and investor confidence. The model must provide the data to back up these documents. Let's start with the business plan. Now, this document provides a detailed overview of your business strategy, market analysis, and financial projections. It demonstrates your understanding of your market and your ability to execute in line with your funding strategy. Within the business plan, be sure to include a section that explains your financial projections in detail and how you came to those numbers, because this allows investors to see the logic behind your financial model. If you don't talk about it in your business plan, the financial model won't make sense. Within the business plan, you have the executive summary. This is your first impression. It needs to be concise and highlight key financial projections directly relating to the funding needs of your business. When creating this document, make sure all the numbers within the executive summary are directly taken from your financial model. This ensures consistency. Investors will immediately notice any inconsistencies, and they may even lose trust in you if your data is not correlated to your financial model. We also have the pitch deck. This is your visual storytelling tool. It must be engaging and clearly convey your financial projections, showing how the funding will be utilized to achieve growth. When presenting financial data in a pitch deck, simplify the data and display it in a very easy to understand way. Investors do not want to see a full financial model in a pitch deck. Be sure to use illustrations and charts to visualize your data. Now, when we talk about the financial documents required, we talk to the financial projections. These are the heart of your investor package. They demonstrate the financial viability of your business and your ability to generate returns aligning with the funding requirements and the expectations of your investors. The projections must be realistic, well supported by data, and reflect your understanding of the market and your business model. This is where your financial model is most important. It is the backing of all the numbers that you put into your investor documents. Before diving into the financial model, it's crucial to understand the key drivers that underpin your projections. This diagram illustrates the core inputs that drive our financial model and inform strategic decisions. The key drivers to our financial model at the top line starts with revenue. This represents total income influenced by pricing strategies, sales volume, and customer retention. We also have the cost of goods sold, the direct costs associated with producing goods or services. This can be segmented into variable costs and fixed costs. Variable costs are costs that change with production level or the number of customers that you have. They are volume driven. You also have operating overheads. These are costs that are related to the day-to-day running of the business. These include salaries, marketing, and administrative costs. Remember, these drivers are fundamental inputs used in your Excel financial model. Now, let us bring this to life. I'll walk you through a simplified financial model in Excel to demonstrate how these principles are applied in practice. Remember, this is a simplified example. In a real-world scenario, your model will be much more detailed and tailored to your specific business. Now I'm going to jump over to Excel. I talked about how you can develop financial models from Excel. Now I'm going to give you a walkthrough of a financial model that you can actually use to develop comprehensive financial projections for your business. At first glance, you can see how well structured the financial model is. The financial model should provide invaluable insights into your startup's financial performance. Investors should be able to grasp the company's outlook and connect it with the information in your business plan. A clear and organized format is crucial for easy navigation. In this model, we have structured the spreadsheet into 3 key sections: a summary sheet, which is what you see here, an inputs and assumptions sheet, and financial projections sheet. We'll start with the summary dashboard. This is designed to give investors a quick and high-level overview of the company's projected financial performance. Here you'll see key financial indicators presented in a visually engaging format in the form of charts and graphs that bring the number. This dashboard includes an indicative valuation, which gives the investors an immediate sense of potential return. We have also included funding requirements and a breakdown of how the funding is going to be utilized. Notice how this dashboard can be used to pull financial snapshots for your pitch deck, making your presentation concise and impactful. After all, this is your first impression for your investors, so it should be clear and easy to understand. Now, let's move on to the inputs and assumptions sheet. This is where the foundation of your financial model is built. Here you'll find key revenue cost drivers that we discussed earlier. These assumptions are critical as they directly impact the projections we'll see later. You will need to make sure that you document each assumption clearly so that investors can understand the logic behind your numbers. Now let's take a look at the key assumptions that you need to input. At the top of the list, you need to input general assumptions. These are assumptions that are related to your market or the economic landscape which you are operating in. This is where you input things like your local currency or the reporting currency. For bias reasons, I have used the Botswana Pula BWP, which is my local currency. However, you may change this based on the market or the country you're operating in. Say for instance, you're operating in South Africa, you may want to put the South African rand here. And this will automatically update all the other pages in your spreadsheet. I'll take this back where it was, so that you can see how when you change one element in the key input section, it updates other pages. What's very important for you to understand about the financial model is that all the blue figures in your financial models are figures that you can always change. These figures drive your financial model, but you can always change to test different scenarios. In your general assumptions, you will have other inputs such as your inflation rate. The inflation rate is a key driver for projected increases in operational costs. The inflation rate in Botswana has historically ranged between 3 to 5%. So, for our financial projections, we will use a conservative rate of 5% to account for potential upward pressure. Specifically, if we anticipate that raw materials or other production costs will be more significantly impacted by this inflation. Another critical factor is market size and growth rate. We are targeting the Botswana market in this instance. The GDP growth rate in Botswana has averaged 3.5% over the past 5 years. And recent projections indicate a growth rate of 3 to 4% for the next 3 years. Based on this, and considering factors like your specific market, you may look at putting this growth rate at 3% or 5% if you are looking to be optimistic. However, you need to be realistic about your growth rate because they are used to project the growth in your revenue. Then we can also input the tax rate. As you know, the tax rate in Botswana was increased by 1.5%. So I'm going to go ahead and adjust this so that we have an accurate number to work with. Then the dividend payout rate. Most startups want to know whether they should pay out dividends or not. Well, it really does depend on the expectations of your investors. Others may want the dividend to be paid out as soon as possible. Others may give you a moratorium of about 5 years where you don't even have to pay any dividends, because most investors, especially venture capital funds, want to see material growth in your capitalization. They are looking at capital returns as opposed to dividends. After looking at these general assumptions, we may look at other assumptions such as depreciation rates. These rates are used to just calculate how you will be depreciating your machinery and equipment if your business is asset intensive. Now you will find that buildings may actually depreciate over 25 years the most, whereas vehicles would depreciate over 5 years. This is when you are looking at the valuation of the various assets that you have, then you can link it to that particular asset. But for now, for this projection, we will use these depreciation rates. Then we have to look at the products that we are offering and try to see how we are going to utilizing the capacity that we have in our operations to provide service to our customers. So if it's a company in tech and you have different packages for different products that you offer, you may have standard, pro, premium. So you may decide to say, okay, this is the capacity that I'm having, and I'm going to allocate it more to standard users than premium users, for example. This is also driven by your business model. You can always change these while you test and see which scenarios work best to maximize your profit. Then you can move on to your costing assumptions. Usually when you are trying to project your costs, it's easier for you to relate it to your sales because some costs, such as direct costs, are directly linked to the volume or the number of customers that you service, as we discussed in our earlier discussions when we are talking about variable costs and fixed costs. So it's best to try and project them as a percentage of sales. This gives you a clear indication of which costing element generates more revenue for you. In this case, if you are in the business of subscription or stream-based business, you may want to have more content that you're generating, which will actually contribute more to your revenue than all the other costs. As you move on, this is now a fragmented costing model that you will be using to build your costings and your revenue figures. For a business that is maybe offering software as a service, or you are offering a subscription-based product, you want to have the projected number of subscribers. Perhaps you want to start with a number that is on the lower side, which will be linked to your market size and the market share that you intend to occupy. So we said our market size is 15,000, and at 10% that means our first subscribers are going to be 1,500 for the first year. Now you will see how over time this rate should be growing on an annual basis or monthly basis. Once you factor in a growth rate of 3%, you'll see that the revenue line will be growing, or your subscribers will be growing on an annual basis by 3%. It will also be a monthly basis. However, it's very critical that you support these figures with market trends. If the market shows that the market grows with more than 3%, then it's worthwhile to revise this figure. Then it will talk about your subscription periods. Others will offer 3-month subscription, while others would be on an annual basis. At the end of the day, it'll show you the annual capacity, that is the subscriptions that you're generating over the year. All these other factors that you need to consider can be put into here. You can also put your churn rate so that you can show the attrition in customers on an annual basis. This gives you a more realistic overview of how your subscription base is going to grow over the years. You may also want to now at this point input your pricing rates. You will have different prices for different products or different services. So here, remember we said we capture figures on the blue highlighted figures. All the other figures that are not highlighted blue cannot be inputted directly because these are driven by formulas for the model. So what you need to focus on is on the blue figures. So here you can put your pricing. Now the pricing will vary by different packages like we said, and this is critical when you are trying to try different scenarios in pricing. You can always come back and change here to see how it affects your profitability. The beauty about this is that on an annual basis, it will also factor in inflation and increase the prices based on the inflation figure that you put at your other assumptions page. Now, after you have inputted the pricing, it will calculate for you the revenue that you expect to generate per annum. Similarly, now that you have the revenue figure and you have already put the assumptions relating to your cost as a percentage of sales, the model will automatically calculate what your direct costs are up to other overheads. So if you had already put these assumptions at the top, it will even calculate all the other items such as research and development. If you had projected, for example, that research and development is going to be 4% of your revenue, this is where the figure will be coming from. Likewise, sales and marketing can also be calculated in the same manner as long as you have put what the actual contribution to cost of sales is for that item. Before we close, I also want to show you a critical element that you need to be looking at when you are coming up with assumptions. These are assumptions related to your fixed costs or your overhead costs. These are the kind of costs that you can't avoid, and you need to make sure that you project these as accurately as you can. Things like salaries. Once you have hired people, you need to pay them on a monthly basis. Whether you're generating revenue or not, these costs are unavoidable and are fixed in nature. So you need to make sure that you project well for them. At this stage, you may also be looking at how you are going to remunerate your founding team. If you are a team of 2 founders, you may look at your salaries. Yes, one may be skeptical about adding salaries, especially if you're going to be having discussions with your investors. But at the end of the day, your investors need to see a realistic view of your operations. And if you are going to be a founder who's going to be actively involved in the operations of the business, it is best practice for you to put a salary figure. However, this may not be related to market rates, but you need to ensure that you factor in all the costs so that the investors are not surprised or they do not feel like you are not being transparent about your operations. Now, all these other calculations are also driven by other key drivers that you would have gathered, especially when it comes to working capital. If I could take you back to the first few pages of our sheet, we have the working capital considerations or assumptions. These are what you expect to be your working capital and turnover days for accounts receivables, inventory, and accounts payable. They indicate how long you'll be able to receive cash or spend cash in terms of your sales and your costing. Accounts receivables relate to your customers who buy on credit. So if you offer 30-day credit to your customer, then you would put it here. Inventory, if you're going to be holding inventory for over 30 days, then you put it here. Then there will be accounts payable. This is where you have credit facilities with your suppliers. What is key in working capital management is that you need to make sure that you collect your money from your sales as soon as possible, and then you negotiate flexible payment terms with your suppliers. Startups are particularly vulnerable to cash flow problems. Effective working capital management ensures you can meet your short-term obligations while you are also making sure that you fund your day-to-day operations. Here are a few strategies. Avoid overstocking, minimize understocking, which will lead to lost sales, and implement inventory management systems to track stock levels and forecast demand. Implement a clear and efficient invoicing process. Send invoices promptly. Offer early payment discounts to incentivize customers to pay invoices faster. Also, establish clear payment terms and credit limits. Regularly review customer credit worthiness. Actively follow up on overdue payments. Remember, cash is king, so you need to develop a detailed cash flow forecast to anticipate future cash flow needs. And regularly monitor and update this focus. We'll get to that. Once you have captured most of these assumptions, there is one key assumption that I also want you to look at, which is your interest rate. Now, with loans or funding through debt, you will be getting funding where you are paying interest for the loan that you acquired. So this is where you put the interest rate so that you can be able to calculate how much interest cost goes into the loan that you acquired. Now, different loans will have different interest rates. You need to be able to negotiate favorable terms for each loan that you acquire so that you can maximize your returns. Same goes to where we are talking about dividends, that you can also negotiate a moratorium so that you can be able to avoid paying interest, maybe over a period of time where you are also trying to scale your business. After capturing all these relevant assumptions, you can now take a look at your financial projections, which are driven by your assumptions. Remember, you may have been operational for a period of time, so it's very important that you capture all the historical data related to your operations. This would be made available by a complete set of annual financial statements that were prepared by an accountant. So you can capture these figures here so that they create a clear trend line for your business operation into the foreseeable future. The projections page presents the financial projections in a form of income statement, balance sheet, and statement of cash flows. Let's start with the income statement. Here we see the projected revenue, cost of goods sold, expenses, and other income. This page allows investors to see profitability of the company and runway for the company. If you look at your profitability over the next 5 years, based on this model, you'll be able to see that the business would be generating profits in the first 5 years of operation, wherein before the period before then, the business was loss-making. Now, the improvement in profit could be due to the investment in the investments that were made into the business. Perhaps they brought about operational efficiency that led to profitability, or they enabled the business to scale their operations and increase their revenue. So these are the various drivers to this income statement, but it's very important that you play around with all the blue figures, even in the key assumptions, and reiterate them to see when the business will be profitable. Moving on to the balance sheet, this shows the company's assets, liabilities, and equity at a specific point in time. Here we can analyze the benefits and trade-offs between debt and equity financing, which is crucial for understanding the company's capital structure. Investors use this page to see the overall health of the company and how the assets and liabilities and equity are balanced. Finally, the statement of cash flow tracks the movement of cash in and out of the business, categorized into operating activities, investing activities, and financing activities. This statement is critical for understanding the company's liquidity and ability to meet its financial obligations. This page is very important as it shows investors how much cash the company will have on hand and how the cash will be used. Now, having had a look at the various inputs required in your financial model, I would encourage you to play around with the variables and test different scenarios. It's crucial for founders to stress test this model by trying different scenarios. This allows you to see the optimal financial model and maximize returns for investors. By adjusting key assumptions, we can assess the risks and opportunities associated with different business strategies. This proactive approach ensures that we are prepared for various market conditions and can make informed financial decisions. Remember, this model is a living document. It should be continuously updated and refined as the business evolves. Now, I understand that this data and information might seem overwhelming at first glance. However, I'm confident that once you start putting your own figures and visualizing your business model, you'll find this tool incredibly valuable. And remember, I'm here to support you on every step of the way. As a consultant specializing in capital raising support for startups, I can assist you with building and refining your financial model and ensuring that your financial documents align with investors' expectations. I will leave my contact details on the screen for a quick access. You can also scan the QR code provided. Please feel free to contact me